Most gurus tell you to buy in the big hubs: New York, Los Angeles, Austin. But if you're chasing 2026 growth, that's a recipe for stagnant returns. The money isn't in the hubs anymore. It's in the migration. The safe bets have become the slowest growers. To find the real winners, we didn't look at last year's trends. We built the 2026 migration map. We've cross-referenced corporate relocations, tax incentive shifts, and net migration data to identify exactly where the high-earning workforce is moving. We're talking about hard data, not hype. In this video, we're revealing the 5 undervalued cities poised for massive population spikes and aggressive rent hikes. You'll learn exactly where to deploy your capital for maximum appreciation before the crowd arrives. Whether you're using PropStream to hunt for off-market gems or scaling via Fundrise for a completely passive portfolio, these are the markets that will define the next decade of wealth. Let's dive in. Most experts will tell you to stick to the major hubs. Buy in the big cities. That's where the people are, right? Wrong. That's exactly how you end up with a stagnant portfolio. Here is the reality. The major hubs are saturated. You aren't just competing with other individual investors anymore. You're competing with institutional hedge funds and BlackRock-level capital. They can outbid you. They can wait you out. And they've already driven the prices so high that your cap rates are practically non-existent. You're paying a premium for a safe bet, but there's nothing safe about negative cash flow. Imagine pouring hundreds of thousands into a property, only to realize the rent barely covers the mortgage and taxes. You're banking on massive appreciation just to break even. But by 2026, the math has changed. The growth isn't in the centers anymore. It's in the fringes, the secondary cities. While the crowd is fighting over the same 3 zip codes in Austin or Miami, the real wealth is being built where the population is actually migrating. If you keep following the herd, you're not investing. You're just paying for someone else's exit strategy. So, if the major hubs are a trap, where is the money actually moving? The secret is the 2026 migration map. We aren't looking for the biggest cities. We're looking for path of progress cities. These are undervalued markets with a specific catalyst: corporate relocations, tech expansions, or infrastructure booms. When high earners move to low-cost cities, rents skyrocket and property values follow. Here are the 5 best bets for 2026. Number 1, Columbus, Ohio. They're calling this the Silicon Heartland. With Intel investing tens of billions into chip manufacturing, thousands of high-paying engineering jobs are flooding the area. This isn't just a spike, it's a structural shift. The play here: mid-tier, single-family rentals in the surrounding suburbs. Number 2, Huntsville, Alabama. Known as the Rocket City, Huntsville has one of the highest concentrations of engineers per capita in the U.S. It's a recession-resistant market because of the heavy federal and aerospace presence. You get stable tenants and incredible cash flow. If you're using a tool like PropStream, look for off-market deals in the northern corridors. Number 3, Indianapolis, Indiana. Indy is the logistics capital of the Midwest. As e-commerce grows, so does the demand for workforce housing. It's an entry-level paradise for investors. Low barrier to entry, steady appreciation, and a diversified economy. Number 4, San Antonio, Texas. While everyone fought over Austin and drove prices into the stratosphere, San Antonio stayed grounded. But it's catching up. It has a massive military presence and a booming healthcare sector. It's the value play of the Texas Triangle. You're getting the Texas growth without the Austin price tag. And number 5, Knoxville, Tennessee. This is the lifestyle migration play. Remote workers are fleeing the coast for the mountains. Knoxville is the perfect blend of urban amenity and outdoor access. This market is prime for a hybrid strategy: long-term rentals with short-term potential. Now, I know what some of you are thinking. I don't have the time to manage a property in Ohio or Alabama. That's where passive vehicles come in. If you want exposure to these types of growth markets without the midnight plumbing calls, look into REITs or platforms like Fundrise. You can put your capital to work in diversified real estate portfolios and let the pros handle the legwork. The goal isn't to own a building, it's to own the cash flow. Now, you might be wondering, how do I actually find these off-market gems before the crowds arrive? I use PropStream. It's essentially a cheat code for real estate data. It lets me track migration patterns and find motivated sellers in these exact 2026 growth zones. If you want to stop guessing and start using data to secure high-equity deals, check the link in the description for PropStream. But look, I get it. Not everyone wants to be a landlord. If you want exposure to these high-growth markets without the 2 a.m. phone calls, Fundrise is the move. It's the gold standard for passive real estate investing. You get the capital appreciation and dividends without the headache. Stop waiting for the perfect time. The 2026 window is opening now. Click the links below to grab PropStream or start your Fundrise portfolio today. Let's build that wealth.